Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Kevin Greene. He's CEO of Tassat. We're going to discuss preserving the diversity in the U.S. financial system. Kevin, it's great to have you with us. Welcome to Trade Talks.
Great, thank you.
Clearly a relevant topic right now as we see bank failure after bank failure. What is the threat of too big to fail banks, and which parties could be at risk if the United States were to adopt a more European-style banking system that's dominated by the big banks and government?
Yeah, it's a wonderful, wonderful question. I think we have to realize, I start with what's at risk right now. Small, medium-sized regional banks provide 60% of all the small business loans in America, about 80% of all agricultural loans. Those businesses, in turn, generate 80–90% of all the job growth, most of the innovation, most of the productivity growth. What we've seen recently, and if you just take First Republic, Silicon Valley Bank, and Signature Bank, you've had about $600 billion in assets taken out of that ecosystem. That's a problem. So we really are at a point where we have to determine, do we want to preserve the diversity of the U.S. banking industry or evolve towards what Europe looks like, which is a handful of banks dominating the economy. What we've seen in Europe is that leads to less job growth, less productivity growth, less innovation. So it's a real problem and a real challenge, something that needs to be addressed.
And I'm glad you brought that up, because when we think about bank failures and bank consolidation, do we have too many banks? Do we have, is there more room for consolidation? To your point, that's not the issue. The issue is if we're not getting capital into the system and small businesses can't grow and they can't invest and they can't hire people, to me that sounds like a bigger hit to the economy than the banks actually merging into one another.
Enormous hit to the economy. It hits economic growth, job growth, innovation, everything about the U.S. economy gets harmed. And that is a real problem. We have to figure out how to solve that problem.
How have regional banks historically supported the underbanked?
Well, they've done it just by being in the local community, just by being available, by knowing the entrepreneurs, being able to understand their businesses, by being supportive of those businesses. When you have a mega bank tends to operate according to very strict rules, and their ability to innovate, their ability to work with an entrepreneur is very limited. That's the beauty of these banks. And these banks grew from just dramatically as the economy grew. So they were good banks doing good things.
Do you think policymakers have been effective preserving the diversity of the U.S. banking system, or are you concerned that deposits are overwhelmingly flowing to big banks? I mean, then you have that concentration risk there.
Yeah, it's difficult to criticize regulators because they have a very, very difficult job. What we think is really important, and why we think what we do at Tassat is so important, is that innovation, technological innovation, can level the playing field between small, medium-sized, and regional banks and the mega banks. So what do I mean by that? Those banks are very close to the customer, and the new technologies that are coming out, particularly private permission blockchain technologies, what we're focused on, gives them tools to serve their customers as well as any major bank. The major banks can invest billions in this technology. Smaller, medium-sized banks actually can invest less and do very well, but they do need the support of regulators, and that's very, very important.
So tell us more about Tassat. You're providing FDIC-insured banks the tools to compete in a digital economy, so you're kind of bringing the nimbleness of a smaller company to banks that have scale.
Correct. Well, we're bringing actually the power of technology. So everything we do is what's called private permission blockchain. It all operates within existing U.S. banking regulations and allows these banks to provide to their customers real-time payments safely and securely around the clock. In addition to that, we have what are called smart contracts, where they can actually create customized financial services on demand for those customers. And there's been an explosion in fintech companies, and they're all great. But our view of the world is the banks have the customers. Let's give them the tools to serve those customers well. Okay? If we give them those tools, they can compete with any bank in the world.
Right. And while you could do payments or payroll, that doesn't kind of solve the lending issue, though, or does it?
Well, it actually makes your lending a lot easier, a lot more efficient. Everything we do makes the systems more instantaneous, cheaper, more efficient, easier to use, and safer, really important. Same goes when it comes to lending. The same technology that's applied to payments can be applied to lending. It's very, very powerful. I mean, we've done over $1.4 trillion in transactions on our platform. We've been averaging about 120 billion per month. So it works, it happens, and it does drive growth within the banks that we work with.
All right, appreciate the insight, Kevin. Thanks for joining
Sure.
us on Trade Talks, and
Great.
thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.